0.39%. That's the average interest rate on a savings account in America right now. The Federal Reserve says inflation is running at 2.7%. So your money is losing value every single day, and you don't even feel it. You think you're being safe, but you're actually getting poorer. By the end of this video, you'll know exactly how to stop the leak and make your savings work for you instead of against you. The number in your bank account is a liar. It tells you you're doing fine, but prices are rising. Groceries cost more, rent costs more, tuition costs more. And if your savings aren't growing faster than those price increases, you're falling behind. The usual advice is to stash cash in a savings account for emergencies. That's smart, but most banks pay almost nothing. The average savings account pays 0.39%. Inflation is 2.7%. That's a gap of over 2%. That gap is quietly eating your purchasing power. In this video, we'll break down the math, show you real examples, and give you simple steps to protect your money. You'll learn how to spot the difference between a savings account that works for you and one that works against you. Inflation is just the general rise in prices over time. When inflation is 2.7%, that means the stuff you buy gets about 2.7% more expensive each year. So your money can buy less. Your purchasing power drops. Think of your savings as a bucket of water. Inflation is a hole in the bottom. Even if you keep adding water, some is always leaking out. If your interest rate is smaller than the hole, your bucket slowly empties. That's what's happening to most people's savings right now. The government tracks inflation with something called the Consumer Price Index, or CPI. It's a basket of typical goods and services. The Bureau of Labor Statistics reported that CPI inflation was 2.7% in December 2025. That's the number we'll use. It's higher than the Federal Reserve's target of 2%, so prices are rising faster than the ideal, and your savings are getting hit. This isn't just about the price of a coffee going up. It's about the value of every dollar you've saved. When prices rise, your money's ability to buy things goes down. That's the quiet thief. It doesn't take a single dollar from your account, but it steals your buying power. And because it happens gradually, you don't notice until it's too late. You might think you have $10,000, but in 5 years that $10,000 might only buy what $8,000 buys today. That's the real cost of inflation. It's a silent tax on your savings, and most people never see it coming. So what does a typical savings account pay? The national average is 0.39% APY. That's barely nothing. APY stands for annual percentage yield. It's the real return you get, including compound interest. With inflation at 2.7%, your money is losing over 2.3% of its purchasing power every year. Imagine you have $10,000. At 0.39%, you earn $39 in a year. But prices go up by 2.7%. That's $270 worth of purchasing power gone. So you're down more than $200 in real terms. And that's just 1 year. Over 10 years, it gets worse. If inflation averages 3% and you're earning 1.5%, you lose about 17% of your real value. That's because the compounding works against you. Your money is shrinking, even though the balance looks fine. The numbers might seem small, but they add up. A 2% gap might not feel like much, but over a decade, it's a massive difference. Let's put it in perspective. If you have $50,000 and you're earning 2% while inflation is 3%, you lose about $6,000 of purchasing power over 5 years. That's a car, that's a vacation, that's a down payment on a house, and you don't even see it happening. The balance goes up, but your buying power goes down. It's like running on a treadmill. You're moving, but you're not getting anywhere. The faster inflation runs, the harder you have to work just to stay in place. You might think big banks are safe. They are, in terms of FDIC insurance, but they pay almost nothing. Chase and Bank of America offer 0.01% APY on savings accounts. That's not a typo. On $10,000, that's $1 in interest a year. Meanwhile, inflation is 2.7%. So you lose $269 of purchasing power. It's like your money is slowly leaking out of a hole. Many people keep their savings at big banks because it's convenient. But that convenience comes at a cost. You're essentially donating your purchasing power to the bank. They use your money to lend to others and make a profit, while you get pennies. The FDIC insures your deposits up to $250,000, so your money is safe. But safe from bank failure doesn't mean safe from inflation. They're two different threats, and one is much more likely to hurt you. Bank failure is rare. Inflation is constant. It's like worrying about a meteor hitting your house while ignoring the slow leak in your roof. The meteor might never come. The leak will eventually ruin your ceiling. Big banks have made billions off customers who leave their savings in low-yield accounts. They pay you almost nothing, then lend your money out at much higher rates. That's their business model, and you're the one losing out. You don't have to accept that. There are better options. Let's do the math. Say you have $10,000 in a savings account, earning 1% APY. Inflation is 2.7%. Your real return is negative 1.7%. That means you lose 1.7% of your purchasing power each year. In dollars, that's $170. So after a year, your $10,000 can buy about $170 less. Even if you earned 1%, your balance grows to $10,100. But the things you buy cost 2.7% more. So your real purchasing power drops. That's the hidden cost. Many people think a 2% APY is good, but with inflation at 2.7%, you're still losing 0.7%. The difference might seem small, but it adds up. Over time, that tiny gap can eat away a significant chunk of your savings. Understanding this math is the first step to making better decisions. It's like having a bucket with a tiny hole. You might not notice the water level dropping day to day, but over months, it's gone. The same with your savings. A 1% gap might not feel like much, but over 10 years, it's a huge difference. Let's put it in perspective. If you have $10,000 and you're losing 1.7% a year, that's $170 gone. Over 10 years, that's over $1,700. That's real money. Money you could have used for a vacation, a car, or an emergency. And it's happening to millions of people right now. Now here's the good news. You don't have to accept those low rates. High-yield savings accounts are offering APYs above 4%, with some reaching 5%. That's higher than inflation. If you move your $10,000 to an account earning 4%, you earn $400 in a year. Inflation takes away $270, so you actually gain $130 in real terms. That's a huge difference. A high-yield savings account is a savings account offered by online banks. They don't have to pay for branches, so they pass the savings to you. They're FDIC insured, just like big banks, so your money is just as safe. The top accounts have outpaced inflation for more than 2.5 years. So this isn't a temporary trick. It's a solid strategy. You're basically plugging the hole and adding water at the same time. It's like switching from a leaky bucket to one with no holes. Same amount of water, but now it stays. The difference between 0.39% and 4% is massive. On $10,000, that's the difference between earning $39 and $400 a year. And with inflation at 2.7%, one of those outcomes grows your money, the other shrinks it. The choice is clear. You just have to make the switch. Another option is a certificate of deposit, or CD. A CD locks your money for a set time, like 6 months or a year, in exchange for a guaranteed interest rate. Right now, the top nationwide CDs are paying 4.3% to 4.6% APY. That's above inflation, so you can lock in a rate that beats inflation. This is especially useful if you think interest rates might go down. The Federal Reserve has been talking about cutting rates. If that happens, savings account rates will likely drop. But with a CD, you've locked in your rate for the term, so you protect your return. The downside is you can't access your money without a penalty. So only use CDs for money you won't need soon. But if you have savings you can set aside, a CD can help you maintain an inflation-beating return for longer. It's like putting your money in a time capsule. You can't touch it for a while, but when you open it, it's grown. CDs are a great tool for the portion of your savings that you know you won't need for a year or more. Maybe you're saving for a down payment on a house, or a wedding, or a big trip. You can lock that money into a CD and earn a guaranteed rate that beats inflation. That way, when you're ready to use it, it's actually worth more, not less. Some people think money market accounts are the answer. They're not. Money market accounts are not designed to outpace inflation. They simply offer higher interest than regular savings accounts. But they may still fall short. For example, a money market might pay 2%. That's better than 0.39, but still below inflation at 2.7%. So you're still losing value. Many people assume that because money markets are considered safe, they protect against inflation, but they don't. Safety from loss doesn't mean you're keeping up with prices. You need to check the actual interest rate and compare it to inflation. If it's lower, your purchasing power is shrinking. So before you park your money in a money market, do the math. If the rate isn't above inflation, you're still losing money in real terms. It's like wearing a raincoat in a drizzle. It helps a little, but if it's really pouring, you're still going to get wet. Money markets are a step up from regular savings, but they're not the solutions. You need to look for accounts that pay above inflation. High-yield savings accounts and CDs are better options. Don't be fooled by the name. A money market account sounds safe and sophisticated, but it doesn't protect you from inflation. Let me tell you about Sarah. Sarah is 25. She just got a promotion. She's been saving for years. She has $50,000 sitting in her checking account. She thinks it's safe, but it's earning 0.01%. Sarah doesn't realize that inflation is eating away at her savings. Over 5 years, with inflation at 3% and her money earning 2%, her purchasing power drops by about $6,000. That's a huge hidden cost. She could have bought a car, a vacation, or invested in her future. But instead, the money just sat there, losing value. Sarah is not alone. Millions of people do the same thing. They think cash is safe, but it's actually shrinking. The worst part, Sarah could have easily gotten a high-yield account earning 4%. That would have beaten inflation and grown her money. But she didn't know. Now she's losing thousands without noticing. The sad thing is, Sarah is actually a responsible saver. She's doing what she was taught, save for a rainy day. But the system is rigged against her. The bank pays her almost nothing, and inflation takes the rest. It's like she's putting money in a piggy bank with a hole in the bottom. She thinks she's saving, but she's actually losing, and she won't find out until she goes to use that money. She might plan to use it for a down payment on a house, but when she gets there, she'll find out she's $6,000 short. That's a tough lesson. Here's a story about the race between inflation and high-yield savings. Inflation spiked to 9.1% in June 2022. That was the pandemic-era peak. The average savings rate was below 1%, so people with cash were losing big. But high-yield savings accounts started climbing. By late 2025 and early 2026, they were paying over 4%. Meanwhile, inflation had fallen to 2.4% in February 2026. That means high-yield savings accounts have outpaced inflation for more than 2.5 years. This isn't a fluke, it's a trend. If you had moved your money to a high-yield account in mid-2023, you would have been earning around 4% while inflation was still elevated. You would have protected your purchasing power. The opportunity has been there. It's still there. The question is, are you taking advantage? Imagine you had $10,000 in June 2022. Inflation was 9.1%. Your savings account was paying 0.39%. You were losing almost 9% of your purchasing power every year. That's $900 gone. But if you had moved to a high-yield account paying 4%, you would have been losing only 5.1%. Still bad, but better. And as inflation fell, you would have started gaining. By 2026, you'd be earning 4%, while inflation is 2.4%. You'd be ahead. The people who made the switch early are now wealthier. The people who stayed put are poorer. It's that simple. The race is still going, and you can still get in. So what should you do? First, check what your savings account is paying. If it's less than 2.7%, you're losing money. Second, consider moving your emergency fund to a high-yield savings account. Look for ones that are FDIC insured and pay above 4%. Third, for money you won't need for a year, look at CDs to lock in a rate above inflation. Fourth, don't fall for the money market myth. Always compare the rate to inflation. And finally, keep learning. The financial world changes, but the math stays the same. You need to beat inflation to grow your wealth. If this video helped you see inflation in a new light, hit that subscribe button. It helps the channel and gets you more practical money tips. And here's a question for the comments. What's your savings account paying right now? Is it above 2.7%? Let us know. Your answer might surprise you. Thanks for watching.